Today we're answering the question at hand. What is the hurdle rate in private equity? By the end of the video, you'll understand what the hurdle rate is and why it's so crucial in private equity, how it shapes the decisions and the strategies of private equity firms, and why it is such a powerful mechanism for aligning interests and driving exceptional performance.
One of the nation's top real estate investors. Within only 7 short years, Dave Seymour has transacted millions of dollars of real estate and has become one of the nation's leading experts in both residential and commercial transactions.
Most people think the path to profits in private equity is pretty straightforward. You buy a company, you improve it, you sell it, you split the profits. But there's a critical number that changes everything. The number is the hurdle rate. Money in private equity flows like water through what we call a waterfall structure. Each level must be filled completely before a single drop moves to the next. This isn't some absurd, abstract type concept. It's the fundamental, if you will, mechanism that drives every decision in private equity. But first, let's break down what the hurdle rate really means in simple terms. The hurdle rate is like a minimum return that private equity firms must deliver to their investors before they can start earning their share of the profits. Think of it as a promise to investors. We won't make money unless you make money first. Got it? The standard hurdle rate in private equity is typically set anywhere between 6 and 8% per year, and it fundamentally shapes how these investment firms operate. Think about it, when your payday depends on clearing an 8% annual return, you start looking at deals differently. You analyze risks differently, manage companies differently. Well, that's exactly what the hurdle rate is designed to do, to shape behavior and drive performance. This mechanism creates a powerful alignment, if you will, between investors and managers, ensuring that both parties' interests are focused on the same goal of making substantial returns. To put this in perspective, let's take $1 billion fund. Before the private equity firm receives a dime in performance fees, it must first return the entire $1 billion to its investors, every single dollar. But that's just the beginning. Those investors also need their 8% annual return. So in year 1, that's 80 million. Year 2 needs another 86.4 million. By year 5, we're talking about nearly $500 million just in preferred returns. This mathematical reality creates an intense pressure cooker environment where every decision is magnified. You see, the standard 8% isn't random. It represents what investors could reasonably expect to earn in other less risky investments. It's their compensation for locking up their money for several years. The 8% benchmark wasn't pulled from thin air. It reflects decades of market experience and the delicate balance between risk and reward in financial markets. Now, why does it even matter? Well, because money has value over time. When investors put their capital into a private equity fund, for example, they're committing it for a long period, usually 7 to 10 years. And during this time, they can't access or invest their money elsewhere, right? They can't get at it. It's locked. The hurdle rate ensures they receive a baseline return for this commitment. What makes the hurdle rate unique is that it's calculated as a compound rate. This means the 8% builds upon itself each year. If a fund holds investments, say for 5 years, investors need to receive more than just 40%. That is 8% times 5 years. They need to receive what their money would have grown to if it had compounded at 8% annually over those 5 years. But perhaps the power of the hurdle rate lies in its role as a sorting mechanism. It helps separate truly skilled private equity managers from those who might just be riding market trends, for example. After all, anyone can generate returns when markets are booming, but consistently clearing an 8% hurdle through different market conditions, well, that requires a genuine value creation. And the hurdle rate also serves as a protection mechanism for investors. This means that if a private equity firm generates only a 6% return, the investors still get all of that return. And the fund managers don't share in any profits because they didn't clear the hurdle. This structure helps ensure that investors aren't paying high fees for mediocre performance. Different types of private equity funds might set different hurdle rates. Growth equity funds, which invest in faster growing companies, for example, well, they might have a higher hurdle rate of maybe 10% or more. Infrastructure funds, which typically make more stable investments, well, they might have a 6 to 7% lower hurdle rates. Every private equity firm comes with its own hurdle rate. However, this creates an interesting dynamic and a strong incentive system in place for private equity firms. Knowing that they need to clear this 8% threshold, they are motivated to pursue strategies that can generate returns well above this level. This shifts their entire approach to analyzing businesses. A 9 or 10% return barely makes economic sense for them. After clearing the 8% hurdle rate, there's little left to share. So this pushes them to target much higher returns, often 20% or more, where the profit sharing becomes more meaningful for them. This helps to explain, if you will, why private equity firms often avoid certain types of companies. Stable businesses, for example, that consistently generate 5 to 7% returns might be good investments for other investors, but they don't fit the private equity model. You see, that hurdle rate effectively filters out these good but not great opportunities. It's one reason why private equity firms typically look at companies they can significantly transform rather than just slightly improve. A private equity firm typically has a 5-year window to transform a company. Now, in that time, they need to not just improve the business, they need to dramatically accelerate its performance to overcome the compounding hurdle rate. The mechanics of this system explain why private equity firms move so aggressively after acquiring a company. From day one, they're racing against that 8% annual hurdle. Every month that passes without significant improvement puts them further behind. They can't just play it safe with minor improvements. They need to make significant changes to the portfolio companies. They need potential for substantial returns to make their business model work. Another important aspect is how the hurdle rate influences investment timing. Private equity firms must consider not just whether they exceed the 8% threshold, but how quickly they can do it. A longer holding period means the hurdle rate compounds, making it progressively harder to achieve the required return. In private equity, every strategic decision, every operational change, and every timeline they set all ties back to this basic requirement of clearing the hurdle rate, driving both innovation and transformation in the pursuit of superior returns. Right, now that we understand how the hurdle rate shapes the private equity landscape, let's see exactly how this plays out in real money terms. The mechanics of how money flows in private equity is really quite fascinating, and they explain why every decimal point matters. When a private equity firm closes a deal, the clock starts ticking on that 8% rate. But the actual money flow follows a precise sequence that many people outside the industry, well, they never get to see it. So let's break it down with real numbers that show why this matters so much. So imagine a private equity fund investing $500 million in several companies. After 5 years of hard work, it sold these companies for a total of $1 billion. At first glance, a $500 million profit sounds impressive. After all, it's a 100% return. However, the hurdle rate mechanism makes this much more complex. First, the original $500 million goes back to the investors. That's non-negotiable. But what about the 8% annual hurdle rate? Well, that comes in next. Remember, the 8% compounds each year. After 5 years, investors are entitled to not just 40%, but about 47% due to compounding. That's an additional $235 million that needs to be paid to investors before the private equity firm sees any profits. That's where it gets kind of interesting. The private equity firm has generated $500 million in total profits, but $235 million is already spoken for by the hurdle rate. This triggers what's known in the industry as the catch-up period, a crucial phase we haven't discussed yet. Look, during the catch-up period, the private equity firm receives all profits above the hurdle rate until it reaches its target share, typically 20% of total profits. This isn't just a technical detail, it's a powerful motivator that drives behavior throughout the investment period. In our example, the total profit is $500 million, So the private equity firm's target share is $100 million, which is 20% of that amount. After the catch-up phase, any remaining profits are split 80-20 between investors and the private equity firm. This three-step process, the return of capital, hurdle rate return, and profit sharing, creates a delicate balance of incentives. This explains why private equity firms often combine operational improvements with financial engineering. They might use debt strategically, maybe implement aggressive cost savings, or pursue add-on acquisitions, all in an effort to accelerate returns beyond that 8% threshold. Understanding these mechanics helps explain many of the criticisms and praises of private equity. Look, the aggressive pursuit of higher returns isn't just about greed. It's mathematically necessary given the structure of these funds. The hurdle rate and catch-up mechanisms ensure that private equity firms only prosper when they deliver significant outperformances. This brings us full circle to why the hurdle rate is so powerful in shaping private equity behavior. Every decision, from which companies to buy, how to improve them, and when to sell them, must be made with these mathematical realities in mind. It's a system designed to align interests, drive performances, and reward only those who can consistently deliver exceptional returns. The hurdle rate might seem like just a number, but as we've seen, it's actually the heartbeat of private equity. It drives behavior, shapes decisions, and ultimately determines which firms succeed and which ones will fade away. So think about what we've covered. That 8% threshold isn't just a performance target. It's a powerful mechanism that forces private equity firms to think differently about value creation. It pushes them beyond simple financial engineering into the realm of genuine business transformations. Look, when your profits depend on clearing such a substantial hurdle, you can't rely on market trends or minor improvements. Private equity firms can't succeed by simply buying good companies and hoping they become great. They need to actively drive dramatic improvements, dramatic hurdles, and that hurdle rate creates a clear standard for success. It stands as an absolute measure. Either you clear it or you don't. And when investors win big, private equity firms win big as well. When investors barely break even, private equity firms make almost nothing. This clarity has helped establish private equity as a distinct form of investment, one that promises not just market returns but significant outperformance. Perhaps most importantly, though, the hurdle rate reveals something fundamental about how incentives shape behavior in financial markets. It shows us that the right structural mechanism can align interests and drive performance in powerful ways. And when private equity firms only make substantial profits by generating exceptional returns, they're forced to develop genuine expertise in transforming these businesses. For investors, understanding the hurdle rate helps explain why private equity firms make the decisions that they do. The aggressive moves to improve efficiencies, the focus on rapid transformation, the careful timing of exits, these aren't just random choices. They're the natural result of a system designed to reward the exceptional results. So next time you hear about a private equity deal, remember the invisible force driving it all. Behind every acquisition, every operational change, and every exit decision, there's a hurdle rate steadily ticking upward, pushing firms to move faster, think bigger, and aim higher. The real power of the hurdle rate, it's not just the number, it's the force that keeps private equity firms constantly pushing the boundaries of what's possible in business transformation. And in doing so, it helps explain why private equity has become such a significant force in the modern economy. Whew, that was a lot, right? Well, it's all for today. If you got some value out of this video, be sure to like and subscribe and click the bell to get notified when I post new videos. I'll see you in the next video, and you can access it right here. Okay? See you soon.